What's up, guys? It is Sam here, and if this is your first time here, welcome. And if you're returning, thank you so much. Now, I wanted to talk about my options trading. Today is July 4th, so the markets are closed. July 3rd, the markets closed a little early, I think at 3 o'clock. And every time I do some trading, I will make a video to update you if you would care to follow along on exactly what I'm doing with my options trading. So, if you want to follow along, make sure to press the subscribe button. I changed my strategy from investing in or trading for maximum profit without any regard to risk after I lost $6,000 or $7,000. And I went from $11,000 and change down to $3,800 in about 2 months. And I only lost $500 of my own money, but to have a portfolio value that much and not have any regard to, not that that $11,000 is a tremendous amount of money, but to have a portfolio value and not take into consideration the risk associated with every single position in a more thoughtful and considerate way is just a very elementary thing to do, in my opinion. So, getting back down to $3,800 in my portfolio, I decided to shift that focus to be able to make enough profit to be able to purchase 1 share of Tesla stock per week. That means if I would like to have enough profit every week to be able to purchase 1 share of Tesla stock. And a little bit of margin above that so that I can continue to grow the portfolio value. And the amount of profit I need every week as a percentage of the total portfolio decreases. So this week, if you want to check out what positions I originally opened up, check out the channel for that. I opened up a position, so this is my current portfolio value, if you can see that, $5,700. So I've made back from the trough of $3,800. I broke past what I originally put in, which was $4,287, and I'm currently at $5,707 as of July 4th. So on one of the 3 positions that I originally opened up this week, on July 1st, was a Tesla put credit spread. What that is selling a put, the put that's closer to the money. So say that stock price is here. You sell a put that's right here, which means if the stock comes down past there, that's not good because you're short. That's what selling means. So I'm short that option. And then to hedge that risk, so you don't have essentially unlimited risk, you purchase one down here. So the stock price is up here, you sell this put and you buy this put. So the payoff diagram, instead of just going straight down negative, it goes down to where it hits the other put, then this put starts to make money, so those two level off. Let me just show you a quick diagram of what I mean when I talk about a payoff diagram. So I would lose money and then it would break even. One would continue to lose, this one would continue to make money. So if hopefully you can see this, I don't think I have a marker around here anywhere to make this darker, but this will do. So this would be a payoff diagram, and this represents 0 here. So this is how much money I would be losing if it broke down past, right? Because the stock price is here, the first put is here. This represents the first put. Between here and here, this would be a loss. And what happens at this point, that's where that bottom put is that I purchased. So this bottom put starts to make money, that's what this dotted line is. This first put is still losing money, so the net of those two is this line here, which means that my max loss is the difference between the 2 strike prices. So I sold a put credit spread. So if your net receives premium, meaning if your exercise price of the one option is closer to the money and the other leg of your position is further away and you receive premium, then it's a credit. If you have to pay, then it's a debit. And so what would be a debit would be the flip-flop of that. Instead of selling the top one and purchasing the bottom one, I would buy the top one and sell the bottom one. And it changes the payoff of that position. But we're not going to get into those. Those are not something I fucking really ever do. So I sold a Tesla put credit spread, the 210 to 202,750. So what did we just learn? The maximum loss on this position is the delta. The delta just means change in. The delta between 210 and 202.5. So that's $7.50. So that's the maximum I can lose, and then each one of these is based on 100 shares, so it's actually $750 I can lose per position. This is just, I'll go back and forth between those two, $7.50 or $750, but it's the same thing. So the premium that I collected per contract was $83, and I sold 2 contracts. So the maximum profit, if Tesla stays above this line here, right, the maximum I can make is $166. And what that is the premium collected on 2 options contracts with 2 legs. So the 2 legs are what I sold and what I purchased, and then I did that twice, so that's 2 contracts. Then that's the maximum I can receive, and I sold that one on July 1st at 10:37 a.m. I closed that position. So to close the position, you just do the reverse, right? So if I sold the higher put option and I purchased the lower put option, I would do the exact opposite. So now I would buy the higher put option, hopefully at a lower price, and I would sell this one down here, hopefully at a lower price, and make the difference. So that's what I did. On July 3rd, which would be yesterday, before the markets closed at 12:33, I closed out the position for $3 per contract, which means that I made $160 on that position. So if you've been following along, I opened up a contract on Netflix on Monday, and I closed it on Tuesday, and I made $70. So between the $70 and the $160 I've made $230. That is almost enough profit to buy 1 share of Tesla stock. I need a little bit more profit, plus I'd like a little bit of margin. So now comes the fun part, because I have a position that's actually moving again. By fun, I'm being facetious. I have a position that is moved against me, or looks like it can move against me. And I also opened up one more position. So first of all, I'm going to talk about the position I opened up. Then I'm going to get into the position that moved against me from Monday. So the position that I opened up was a Amazon put credit spread. So what does that mean? That's the puts where I sell a combination of buying and selling, and I receive premium, right? Because I said credit, which means I get credit. If it was a put debit spread, then I'd pay, but it's a credit spread, so I receive premium, and it's on Amazon. This expires on 7/5, I think it is. Yep, 7/5. The total amount of premium per contract was $18. So this was around, they give you like a probability of being in the money, but it's just a very brief snapshot of people. I think a lot of times assume that that's going to stay constant throughout the duration of their options contract, but it's just a very brief snapshot of whether at that moment if it's going to expire in the money or out of the money. So I've been going further out of the money. So the premium is only $18, but I did 2 contracts. So the most that I can make on this is just 18 plus 18, which is $36. And I opened this one up on, let's see here, July 3rd, 2019. So this one was shortly after I closed out that Tesla position. and so far I've made about $4. Now, with Robinhood, you do not have to consider trading costs explicitly from the standpoint that if you're using some other brokerage platform, you have to pay for every single trade. Robinhood is 100% free. That's why I use it. My girlfriend uses it, and I've told my brothers all about it. I just love that it's absolutely free. I've had many different brokerage accounts over the years, and this is by far my favorite. There's a link in the description. If you do sign up and you fund your account, you get a free share of stock. I also get a free share of stock, but if you want a free share of stock, generally the value is between like $3 or $4 to $6. You can get some up to like $150, but generally the most common stock award is around $5. I got a share of, I think, Sirius XM when my girlfriend started funding her account. So anyways, if you'd want to check it out, it's 100% free. I use it myself, so I'm not going to recommend something that's not, like, I wouldn't recommend you using something if I didn't personally believe in it. I believe in Robinhood. I've been using it for, I think, about 1.5 or 2 years now. So I love it. Now, what's the position that's losing money? And this is getting kind of close. This is the Netflix call credit spread. So the same thing works on the call side. If it's a credit, I receive money. If it's a debit, I pay money. It just happens to be calls instead of puts. So this one here, let's take a look here. It's making me sign into my account real quick. I guess I timed out. This one I also opened up on Monday, and this is a bearish type position, which means that you either want the stock price to stay the same or decrease. And I received $28 in total, which means that each contract was $14. I received $14 and $14 for 2 contracts. This is the 387.50 to 392.50. So what's the maximum loss on this one? Is $5 per contract times 100 shares. So that would be $1,000 times 2 contracts, or $500 per contract times two contracts. That's $1,000 total. And right now, if you look at actually Netflix, the price of Netflix is $382. So the price has gone up since Monday. On Monday, let's see here. On Monday, the first, it was $375. So it's gone up by $7. There's definitely a potential where that could go up above. So how it works with the call is if it goes above that bottom threshold. So now we're doing the same thing, but in reverse, right? So stock price is here. We have a call right here that we're going to sell. And then we have a call above that we are going to purchase. This one's cost more, so when you take the delta of those two, I receive credit. What happens? Same exact thing is happening here. Same exact thing that happens here, except for the payoff diagram looks more like that, upside down. So if it goes up here, then I lose money, and I lose the difference between the 2 strike prices. So if it goes above 387.50 by Friday, right? Because there's no trading today, and there's definitely a potential for some type of pop on Friday. More than likely, it will be a light trading day, but we'll see how this plays out on Friday. It could shoot up, so more than likely, there's a very, very high probability that I wouldn't lose $1,000 because I could probably close it out at a loss of a couple $100 if need be. But right now the position is negative $32, which means that I've received 28, and the market value if I closed out the position right now would be $62. So if you take what I received plus what I would pay right now, the delta on that is $32. or 34 or something. However, I can't close it because the market is closed today. So I will keep a close eye out on any news that comes out between the rest of today and tomorrow. And keep you guys posted. If you have any questions at all, leave them down below in the comments or reach out to me on Instagram. Link is in the description. Share this video with somebody else if you found any value in it and you think they might get something out of it. Appreciate you guys. Peace.